Okay, so we're going to go and have a look at the technical side of preparing for a central bank and look at three specific trades here as well. This is something that I think is often overlooked when people go and trade central banks. What they think about is what could change, what's the big news, where's the big chance to jump in on the trade. Often, particularly in a situation where it's a more interpretations type scenario, a scenario that perhaps doesn't give any clear-cut decision one way or another, that provides a very obvious or very strong directional trade, you will then have a market that then, after all the info is out there, you get flows coming afterwards, and the technical situation that market may well have set up beforehand can often play out. The great thing about this is you've got so much more volume in the market, you've got so many more participants in the market, and that means some of these technical plays can play out quicker, can play out with more aggressive, more obvious, more clear price action. And so having a very good, strong view of what your market is doing just before any kind of meeting can offer you a trade after all the information is out there, or even an ability to sort of bias which way you prefer to be looking to go. If you've got a market that's setting up very bearish, for example, then anything that gives a slight tip for a bearish move can often then play out much quicker with much more ferocity, much more volume. So let's go and have a look at those three different ways that we can be looking at technical trades as they play out over any kind of central bank event. Right, let's go and have a look at the three different types of trades that we'll be looking at. I'll give a brief explanation of them, and then what we'll do is we'll go through, have a look at different examples of how each of these trades can actually play out. We're looking at ECB events, Bank of England events, Fed events, to try and explain some of these ideas. Now, there's not a clearly defined, this is exactly what you're looking for every time situation, but what I try to do is categorize these into three different types of trades that have potential to play out, particularly when you've got that much more volume traded through in the market. So, three types of moves that we're going to be looking at. First up, a structural completion move. Now, like I say, I'll explain this in more detail, but the whole idea of this is a trade that you'd be looking at on any day from a technical point of view, thinking this market needs to go and trade that area. Perhaps this is because we've left a gap behind. Whatever reason it is, you've got a bit of structure in the market that looks like if we can get into the right place, that trade can play out to perhaps break a certain level, retest a certain point. The reason that this is so important, as I've said before, is because it's a central bank event. There's so many more participants, there's so much more volume in the market, and therefore it can reach these areas that much quicker. So that's your first trade, and we'll go and have a look at this. This is often a trade that plays out after the information's there, and can be quite a steady trade to play out, but often can offer a lot of distance in that trade. Next up, a position squeeze. And this offers you a fade or a reversal situation. This can often be a situation that allows you in very early on a move, that you'd be looking at a market thinking, right, well, I know people are positioned one way here. If you get a break below a certain point or above a certain point, a lot of those positions that are playing for a certain scenario over that central bank may well get pushed out. And it could well be that just on that decision, even the most marginal piece of information that goes counter to most of those positions could push a lot of them out, only to see them all rush back in and enter once again. And this is what you're looking for, and that's where that fade opportunity comes in. So what can happen here is you can be looking at a market thinking, right, if we break through here, for example, break to the downside, if we break down and you don't actually see a huge amount of information that justifies that breakdown, you can then use that as an opportunity to fade that move back up, get yourself into a position potentially to then take out the other side of the range, as those who go for that early quick little drop down, which it ultimately is really a technical squeeze of positions, get themselves trapped short in the example I'm just using, and then have to come out to the upside. And finally, we're going to have a look at a continuation. This is a situation which I think most people are going to know what a continuation type trade is, whereby you've got a market that is set to go in one direction, and if you can break a certain point, then you've got a continuation of the current moves. And ultimately, with the technical planning going into any of these events, it's all about looking at what could happen in the absence of any major change. And that's what you're really looking for, because in the absence of any major change, you've still got a load of people in the market that want to act, want to do something. And as they start to act, that then creates the movement, that then puts the volume into the move and can allow that move to continue onwards. So we'll move on and we'll go first up and have a look at a structural completion trade, perhaps the one that requires the most explanation, but the one that can often offer the largest of moves. Okay, so let's go and have a look at structural completion. Now, what you're looking for here is a market that's left a piece of structure that hasn't fully traded out. Now, this could be an area of poorly moved prices higher, for example, so a sort of grind up. That's an area then the market can trade all the way back through. Other things you could be looking for is a gap, one way or another, that is yet to be tested. A poor high, a poor low. So all of these reference points that are giving you a point that the market perhaps should go to in the event of no other news. So that's what you're looking for a structural completion. You're looking for the market to then take on the information and then go and complete the move that is already a trade that you would, in most cases, have as a potential scenario to be taken on that day anyway. So, key parts of actually trading this type of move. Main thing you need to be thinking about is establishing an access point. At what point does this trade become a viable trade? At what point does this completion of that structure actually set up? Because there's no point in just playing for it straight away at the beginning of the event. It's a case of waiting and knowing where exactly the market needs to get to, and once it gets into a certain area, then you know you've got a certain type of trade on. That's the point where your conviction grows. That's the point where you want to build your size into the trade, take the maximum amount of risk, because you know that you've got the volume behind you. You know you've got the participants in the market that can drive the market towards completing that structural move. So that gives you where to get into the trade. What you've also then got to be looking at is how it's likely to move. How is it actually going to do the move? And it's your expectation of this that then allows you to stay with that trade as the move begins to progress. So what you've got to be thinking about is, what's the price action going to look like? Are we going to see a pickup in pace? Where are you going to expect to see a little bit of slowdown? Are you sort of thinking, right, we're going to get down to this point, likely a little slowdown, consolidation sideways, and then a further break? And that allows you to not only clarify your access point down, but also give you a way of adding into the trade or feeling comfortable, feeling certain that the trade is going to work out. It also, as well, gives you a little bit of a questioning once you're in the trade. Is it playing out as you expected? Because if it's not, it may well be a case to sort of step aside and say, okay, not now, and come back to it. You've still got the same access points. Maybe there's a second wave, a second attempt at playing that trade. And finally, it's then down to your execution. In many cases, a trade like this is often going to give you a sort of passive early execution. You're going to be able to recognize that nothing is coming from that central bank meeting, that there's no decision that really changes the current situation. And therefore, with that out of the way, you can now go and play for that trade. So you can enter the trade with quite a passive early entry. This is, in a way of feeling that trade out, getting yourself in and letting the market drift or move towards where you want it to get to, towards the point where you can then increase your conviction and add on to that trade. The alternative, you don't have to get that early position on. you can be waiting in a certain area and looking at that to say to yourself, right, once we get here, that's where I'm getting in. That's your real access point. That's the momentum part of the trade. So both offer you an access point. It's then giving yourself options that if you don't get in at the first, you can get in at the second. If you're in at the first, you can add at the second. It also means that it accommodates numerous styles, whether you're a momentum trader or a more passive continuation trader, someone who's willing to wait for that larger move. So what we're going to have a look at is the ECB back in June. And this was a meeting that didn't give us a huge amount, but it did give us some nice technical setups. And that's the real key thing that we're looking for. And there was a structural trade, particularly in the bund, that we'll look at, that gave you a very clean opportunity after the press conference. So after Mario Draghi had spoken, after they'd given all the information that they wanted to give, you then got a move that goes for a bad low. That's what we're going to have a look at. Look at the access point, look at where this starts to tip in your favour, and also the clues that you get, the technical planning that goes into actually executing this trade. So how you come up with the idea, what clues you're getting early on, and then going down into the details of where exactly you want to get into the trade, where you plan to have the most risk on, and what you're expecting to happen as that trade breaks. Right, we'll move on to that. We're going to have a look at the ECB from June. Alright, we're going to take a look at the ECB from June the 5th, 2019, and look at two structural trades, structural completion trades that is, one in the bund, one in the euro. Differing trades, they have a similar element of bad lows in them to trade, but it's where they're starting off from and the nature of how the market is trading that gives you a little bit of a different scenario. So we'll go and have a look at both of them in terms of building up that technical play of how you would want to execute it, where you would want to execute that trade, and then also what potentially could be said that would give you that as a potential trade. So let's start off with the bund. Now you can see from the chart here, what I've got is a profile chart on the left and an hourly chart on the right. Now the profile chart, for those of you who aren't too aware of profile, what it's showing you, and where I've got it highlighted, the two bad lows at 85 and 79. For a move to complete, you would expect to see the market put in a tail on a profile. Where you're not seeing a tail on that profile, what that's indicating to you is that the same price has caused the market to stop time and time again. This effectively means that you've got a lot of people all long at the same price, potentially all about to come out if that price trades back through. So from that point of view, you've now got 85 and 79 that if we can get down to those areas, you'd expect a relatively quick move through as people start to stop out. So that's the beginnings of your structural trade. What you've then got to be looking at is where this trade could develop from. What's got to happen in order for this trade to become a tradable opportunity? Because yes, you could sell it at the beginning of the press conference and hope that it goes there. But that's not really a trade that has any structure to it. You need to find yourself a way to get into this trade. So what I've got on the hourly chart is your potential move. And what you're looking for is a move back into the range established in the days in the run up to the ECB. So we've had the Friday, Monday and Tuesday, and even the majority of Wednesday, all sit in quite a tight range going into the ECB. Any movement back into that range below 170-117 starts to set up this opportunity to trade through those bad lows and down towards 69s. Now, as mentioned before, because of the additional volume and number of participants in the market over these central bank events, this then makes this a move that could potentially play out in a matter of hours, possibly even shorter than that, potentially even around 15 minutes could play the whole move out because of the additional volume in the market. So you know this trade's out there. We'll go on in a bit to consider the expectations and what could come of those expectations that could set this trade up, that could give you an opportunity to actually play this trade, because in the event of something particularly dovish, you're never going to get that opportunity to sell below 170, 117. So we need a scenario, we need something to happen, or in this case, more likely, something not to happen, that then allows for this play through that range. So the trades there, what we'll do now is we're going to have a look at it on a slightly shorter term to actually pinpoint the areas where you would want to try and execute this trade. And that's the really key part to a technical trade, a structural breakdown trade, is that you need to find the specific areas where this trade becomes much more likely. And from an hourly chart, that's not overly clear apart from below 170, 117. So we'll get it down onto a shorter time frame and try and pinpoint some of those areas. So your next step, having come up with the wider idea of how this trade may work out, what you need to be considering is how it could actually happen. What needs to happen, where do you need to get to, and where can you enter this trade? So I've got two boxes drawn, larger box at the top, smaller box down below. The larger box at the top to me indicates a more aggressive type play, a play whereby it's a move back below those 17s, and as long as we don't move into that box and back out of it, this potentially is setting you up for a move down towards the lower box and ultimately towards the lower blue line, which indicates the gap fill at 170.69s. So that's going to be your first trade. Now you're going to need a slightly different scenario to play that than you would for the second trade. The first trade is going to require a more clear hawkish scenario, whereas the second trade, a move into this little zone that was established on the Wednesday before, that zone between 96 and 85 was effectively an attempt to sell. It was an attempt of the market to move lower, to take out those 79s and go and fill that gap. But it ran into support. This is people positioning themselves for the ECB, trying to get themselves long and preventing the market falling. Anyone who sells, they absorb it. They keep the buying going, and they keep the buying at a higher point at those 85s. This is how those bad lows are created, for one. But what this also does is that creates a zone. Anyone who's long between 96 and 85 in that lower box is not going to be keen to hold on to that if, in the event of the ECB not producing a move that they're looking for, they're then wrong if it's come back to them. There's less likelihood that anyone is actually going to buy it there. So the way that you can be structuring this trade is, first up, you've got your trade through the 17s to try and play for the whole move. Alternatively, your chance of breaking down towards 69s becomes much, much higher once you get inside those 96 to 85s area. This is where you'd be looking to access the trade. This is where you could be looking to put on more risk, and your expectation, and this is really key, your expectation is that once you come out of that box to the downside below 85s, that this should be a fast move. This is a liquidation type move, people coming out of positions. So you see a fast move down, selling into the bid, and again, and again, and again. What this will mean is that there's very little opportunity for you to actually sell once it exits that box to the downside. So the important element of getting into this trade is to make sure you get the position on between 96 and 85, and not to take anything off until you break 79. Once you break 79 and you get into that gap, there's nothing to stop it. There's nothing to stop the market all the way down towards 69, meaning that you've got 10 ticks of free space, which you should be looking to trade through and exit as you get down towards filling that gap. So that's the trade that you're looking for. Of course, the result of the decision could take that away completely. If it's something extremely dovish, then there's no opportunity there. And that's why the expectations are also going to matter. But in the event of nothing overtly dovish, this is a very clear opportunity that could become available in the Bund. What we're going to look at now is the euro as well, and how that has a slightly different, whilst similar in nature of poor lows type trade, a different scenario in which that will play out. because of the fact that the euro is exhibiting a slightly more bullish bias. So we'll go and have a look at the euro now, and then we'll go and have a look at scenarios based on the expectations. Now the euro is exhibiting a slightly different scenario from the bond, and one that could play out that little bit quicker and that little bit earlier on. We'll come on to why, and we'll come on to scenarios in which that could play out in the next couple of slides. We're just having a look at the structure. What we can see from the euro is that this is a market that has put in a bit of strength recently. It's a reversal off lows. We've broken a recent uptrend, and we've started to progress the move back up towards the 113s, as you can see on the daily chart on the left. So we've got an overall relatively bullish looking market. Now, the similarity with the bund is the poor lows. These come in at 112.31. This is where you get a structural completion trade. What you're going to be looking for is any move down towards 12.31 could potentially provide quite a quick flush through. Because this level's been traded, and you can see it on the hourly chart on the right, this level's been tested 5 times with no break. Therefore, there's going to be a lot of stops positioned just below that area. As such, any move down towards that can provide a quick flush down into the box lower down. That box comes in between 112.12 and 112.03. This is your next area of support and would complete that structural trade to the downside. So the idea being similar to the bund, that you've got bad lows that need to trade through, but with the euro, this is a structural trade which needs to complete before then progressing a larger move to the upside, giving you 2 distinct different trades here. First scenario that you're looking for is an opportunity to trade through those 31s. So if you get a scenario that allows a quick early entry, potentially a sort of binary type trade, that quick early entry, if you can get short before 112.31s, will mean that you're expecting to see a fast move down into the lower box. That would complete the structure to the downside, and that would be a trade that potentially could play out very, very early on. This means you can then structure which market you want to be focusing for the decision phase of the ECB. The second scenario that you could be looking for here is once that structure is completed to the downside and you've moved down into that lower box, first up you could have a very quick fade there. If it's only a mildly dovish scenario, it's still likely to break through the 112.31s because of the illiquidity in the market, because of still the amount of volume that's going to get pushed through whilst in a low liquidity phase. So that potentially provides you a fade from the lower box at 112.12 to 03. Alternatively, once the structure's been completed to the downside, the bullish bias of the market can come back in as soon as you get back up above 112.31. Therein is your next trade. If we get back above 112.31, you've then got the scope for a long trade looking up towards that higher blue line that's been established, and that comes in at 112.64. And that would be a secondary trade after an initial break to the downside. That then provides you a trade to the upside. So a distinctly different scenario to the bund, but both giving you a structural completion trade that will perhaps play out at different phases of this ECB decision. What we'll do now is we're going to have a look at scenarios that could come to fruition that could allow you to play either of these trades. So we're going to address those just now, and then we're going to have a look at how these trades actually then play out. In terms of how you're going to manage these structural trades, now you need to understand the expectations and also understand the scenarios that are going to override this play. If you have a situation in, say, the bund that is extremely dovish, let's say for example a rate cut against expectations, or similar in the euro, so a rate cut against expectations or the beginning of QE, yes, you'll get the completion of the move to the downside in the euro, but it's unlikely then to reverse as well. Likewise, with the Bund, anything particularly dovish is not going to allow that structural trade back through that range. So you need to always be weighting the idea of the structural trade against what's expected and how those expectations will match up to allowing that trade to be played. So it's a case of what would override the play rather than what actually plays into this structural idea. In terms of expectations going into this meeting, there have been speculation that the ECB could do something, that the ECB potentially could explore cutting rates, that the ECB could possibly reinstate QE. But all of these scenarios were seen as something that was likely to come up perhaps more in September as opposed to June, and would be quite a big step for the ECB to take. They just started a new TLTRO, and this TLTRO, TLTRO, was going to have the details of it published at the June meeting. That was the main expectation, and it was a lot of focus around the details of this. Anything else is a relatively small chance of a rate cut, possible change to language. So their new language reference was that rates would stay at present levels through the end of 2019. There was a possibility that this gets changed to through spring, H1, H2 of 2020. The other thing to be looking for, and this goes back to the examples that we talked about when they first instituted QE, the phrase took policy action is very, very key. If this comes out at the beginning of the decision, that gives you a very strong clue that the ECB has taken some action. This then means that a trade can be taken on this. Now, there is your first potential trade. If you see that reference to takes policy action, then you've got an expectation that the euro will take that to mean more than just details on the TLTRO and potentially rate cut, potentially change in language, new QE. And so that would then be your opportunity to sell the euro before you get to those 31s for that quick rush down. There's your dovish spike. If, however, there is nothing more and it is just purely the action on the TLTROs, then that's where you can have the reversal. With the Bund, unlike the euro, it's not such an early trade. To get a move all the way through those 17s, you're going to need quite a hawkish scenario. This is not what anyone's expecting from the ECB. And even if they don't do anything, that's not going to be an absolute clear-cut hawkish scenario, because you've still got the press conference ahead. The press conference, whilst they don't do anything at 12:45, may well still offer you indication as to a dovish scenario going forward, and so that early trade isn't so much there for the Bund. So in terms of how this breaks your trading up, it suggests that early on you might want to be more focused on the euro for that structural trade to the downside, and then in the event of nothing new, you then have the Bund trade to try and play it back through the range for those poor lows. So a trade that's going to take a little bit more time to play out, one that you've got more time to consider and work out exactly when is the right time to get into this trade. So there are your scenarios, and this is the importance of weighing up the expectations against what would help that scenario play out. And in this instance, the euro is the one that's perhaps going to play out earlier and provide you with that quick opportunity on that structural completion through 112.31s. Right, what we'll do now is we're going to have a look at how these played out, where you could have accessed the trades, how you could have taken those trades on, and how they also related to the information that we received. Okay, so we're 30 seconds away from the decision. The main market, as we discussed in the previous slide, to focus on is the euro here. This is the one close to that level at 31. And what you're looking for is anything dovish. Any suggestion that the ECB has taken action should be enough to provide you a trade to get short before 31s. If you can manage that for the quick stops type move below 31, down into that box that we previously mentioned around 12s down to 03s. So decisions about to appear. They took action. You get the opportunity to get short beforehand. Then we get the fast drop down into the box and straight back towards 31s. No break of 31 this time, and you get a second chance down towards 14, 15. But this is now where, with that structural completion, we now need to see more from the ECB to keep this going. We're not seeing it in terms of rates. We're not seeing the language change either, and straight away we're back through 31. Now everyone who's sold below 31s is trapped, and this is what's causing the quick move up that you're seeing now up towards 112.50s, and then having held 112.41, 42 area, we then continue to progress. It's very clear now that all the ECB has done is small change to language and just information on the tail trades. So we hold 42 again, push up towards 55. Your next target is going to be 64. And this was all down to that structural completion. You got the quick flick through 31s and the stops as would be expected. So very fast move there. But unless the market could hold below there, unless you had a particularly dovish scenario, you are unlikely to stay below 31 in an overall bullish market. So you had the fade opportunity or the reversal trade as you come back through 31 to get yourself long to try and play for a move up towards 64, which, as you can see, we've reached 64 now. We're 2 minutes after the decision, and you've had a range of around about 50 ticks established, an opportunity to get short for a very quick opportunistic smash and grab trade, and then having seen no real change from the ECB, a chance then to get long to play it. I would say a more steady trade, but still a very quick trade. Once 31 goes, everyone who's short, everyone who's sold on that, took policy action, has to come out of their positions, and that creates the rush up towards 64s. Following that, it's then a case, and as you can see now, we're starting to consolidate around about 112.56 up to 112.62, not breaking that area to the downside. This is suggesting that we can keep the move going, that we can get through 64, potentially up towards 86, as you can see on the charts on the right. So what you're looking for is, where does this market drop to? And consistently we drop down to 12.56. Can't get through there. Once again, push up towards 62, 63 area. And this time we're now starting to hold at 60. You see a little bit of buying coming there at 60. And the market holds. We're not getting that pullback to 56. This is showing you that the buyers are willing to come in higher. And that's what would be suggesting that you can get the break of 64 and then potentially a continuation, as I say, all the way up towards 86 to keep this bullish trend going. So there goes your 64s. This is where you'd then be looking for a continuation. Yes, a quick flip back to 63, but you're still looking now, continuation up, continue to break new highs towards those 86s. So all this was all about that, understanding which market to be taken for that early structural trade. The euro had the setup to break those lows very quickly. We were trading right near it, and you had a good expectation of stops. As soon as that didn't result in anything further though, this is where you could then start trying to play the reversal trade back through those 31s, which offered you that continuation up towards those 64s. No break this time. If you are still long from 31, this potentially could be an opportunity to try and take that profit. You've still got a 30-tick winner, but it's failed this time to rush through those 64s. That's what you're looking for on these structural completion trades, and that's what you're looking for on a very quick one, a quick stop out type trade.